You've been getting Paycheck for years, but have you ever actually looked at your pay stub? Most people glance at the bottom line and move on, not realizing they could be overpaying taxes, missing benefits, or leaving money on the table. Today I'm going to walk you through every line of a pay stub so you know exactly where your money goes. The first thing to understand is the difference between gross pay and net pay. Gross pay is the total amount you earned before anything is deducted. If you earn $60,000 a year, your gross pay per biweekly paycheck is about $2,308. Net pay is what actually hits your bank account after taxes, insurance, and other deductions. The gap between gross and net is where all the action is. For most workers, 25 to 35% of their gross pay goes to various deductions. On a $60,000 salary, that means $15,000 to $21,000 per year never reaches your bank account. Understanding exactly where that money goes is the first step to optimizing your paycheck and making sure you're not paying more than you should. The biggest deduction for most people is federal income tax. The amount withheld depends on your filing status, the number of allowances on your W-4, and your income level. This is not the final amount you owe. It's an estimate. When you file your tax return, if too much was withheld, you get a refund. If too little was withheld, you owe. The goal is to get this as close to your actual tax liability as possible. FICA stands for the Federal Insurance Contributions Act, and it covers Social Security and Medicare. Social Security tax is 6.2% of your gross pay, up to a wage cap of $168,600 in 2026. Medicare tax is 1.45% with no cap. Combined, that's 7.65% of every paycheck. Your employer pays a matching amount, so the total contribution to these programs is 15.3% of your salary. If you live in a state with income tax, you'll see a state tax deduction on your pay stub. Rates vary wildly from 0% in states like Texas and Florida to over 13% in California for high earners. Some cities also charge local income tax. Check your state's rate to make sure the withholding looks correct. If you recently moved states, make sure your employer updated your withholding. Pre-tax deductions come out before taxes are calculated, which means they reduce your taxable income. These include 401k contributions, health insurance premiums, health savings account contributions, and flexible spending accounts. If you contribute $500 per paycheck to your 401k, that $500 is subtracted from your income before taxes are calculated. This is why maxing out pre-tax deductions is one of the most powerful tax strategies available. Post-tax deductions come out after taxes are calculated. These include Roth 401k contributions, life insurance premiums, disability insurance, union dues, and wage garnishments. These don't reduce your current tax bill, but some, like Roth contributions, give you tax-free growth that pays off enormously in retirement. Review these carefully to make sure you're not paying for benefits you didn't sign up for or no longer need. Your pay stub also shows year-to-date totals for everything: earnings, taxes, and deductions. At least once a year, compare your year-to-date federal tax withholding to your estimated tax liability using the IRS withholding calculator. Also verify your 401k contributions are on track to hit the annual max, if that's your goal. And check that your benefit deductions match what you signed up for during open enrollment. Errors happen more often than you'd think. Pull up your most recent pay stub right now and go through it line by line. You might find you're overpaying on taxes, missing a benefit, or not contributing enough to your retirement. Subscribe for weekly finance breakdowns, and check the description for a free pay stub audit checklist.